Imagine you're at a bake sale and you see two delicious-looking cakes. One is a simple vanilla cake and the other is a fancy chocolate cake with all the toppings. The vanilla cake costs $10 and the chocolate cake costs $20. Which one is the better deal? It's tough to say without knowing how big the cakes are, right? That's where the P/E ratio comes in handy for stocks. The P/E ratio is like comparing the price of a cake to the size of the slice you get. It tells you how much you're paying for every dollar of earnings that a company makes. The P in P/E stands for price, which is the current stock price. The E stands for earnings per share, which is the company's profit, divided by the number of shares. So the P/E ratio is simply the price of a share divided by the earnings per share. Why should you care about this ratio? Because it helps you understand if a stock is overpriced or underpriced. It's like finding out that the vanilla cake is actually twice the size of the chocolate cake. Suddenly, the vanilla cake seems like a much better deal. A high P/E ratio could mean that investors are really excited about the company's future growth potential and are willing to pay a premium for its stock. Or it could mean that the stock is simply overvalued. On the other hand, a low P/E ratio could mean that investors are not very optimistic about the company's future. Or it could mean that the stock is undervalued and could be a bargain. Think of it like the story of the tortoise and the hare. In this classic fable, the hare is quick and overconfident, while the tortoise is slow but steady. A company with a high P/E ratio is like the hare. It's expected to grow quickly and capture the market's attention, but it might be taking on more risk in the process. This rapid growth can be exciting, but it often comes with volatility and uncertainty. Investors are betting on its future potential, which isn't always guaranteed. On the other hand, a company with a low P/E ratio is like the tortoise. It might not be growing as fast, but it could be more stable and less risky. This stability can be appealing to investors who prefer a more predictable and less volatile investment. The tortoise's slow and steady approach can often win the race in the long run. For example, let's say you're looking at two tech companies. Both have their unique strengths and weaknesses. Company A is a hot new startup that's developing cutting-edge technology. It's innovative and has the potential to disrupt the market. It has a P/E ratio of 50, which is considered high. This high ratio indicates that investors are optimistic about its future growth. Company B is a well-established tech giant that's been around for decades. It has a proven track record and a solid customer base. It has a P/E ratio of 15, which is considered relatively low. This lower ratio suggests that the company is more stable and less risky. Does this mean that Company B is a better investment than Company A? Not necessarily. The choice depends on your investment strategy and risk tolerance. Company A might be more expensive because investors believe it has the potential to grow much faster than Company B. This potential for rapid growth can be very attractive. However, there's also a higher risk that Company A might not live up to its hype. The market can be unpredictable, and high expectations can sometimes lead to disappointment. Section 4, Trailing and Forward P/E, Looking Back or Gazing Forward. In this section, we will delve into the nuances of these two types of P/E ratios and understand their significance in financial analysis. There are two main types of P/E ratios, trailing and forward. Each serves a unique purpose and offers different insights into a company's financial health. Trailing P/E uses a company's earnings over the past 12 months to calculate the ratio. This method relies on actual historical data, providing a snapshot of past performance. It's like looking in the rearview mirror to see where a company has been. This retrospective view can be very telling of a company's past stability and profitability. Forward P/E, on the other hand, uses analysts' estimates of a company's future earnings to calculate the ratio. This approach is more speculative, focusing on potential future performance. It's like looking through the windshield to see where a company might be going. This forward-looking perspective can be crucial for investors aiming to anticipate future growth. Both trailing and forward P/E ratios have their pros and cons. Understanding these can help investors make more informed decisions. Trailing P/E is based on actual historical data, so it's generally considered more reliable. It provides a concrete basis for evaluating a company's past performance. However, it doesn't take into account any potential future growth or challenges that a company might face. This limitation can be a significant drawback for forward-thinking investors. Forward P/E, on the other hand, can be more useful for trying to predict a company's future performance. It allows investors to gauge potential growth and future profitability. However, it's based on estimates, which can be inaccurate. Analysts' predictions are not always correct, and unforeseen events can drastically alter outcomes. It's like trying to predict the future. You never know for sure what's going to happen. Therefore, while forward P/E can offer valuable insights, it should be used with caution and in conjunction with other financial metrics. Section 5 PE ratio, in action comparing companies and industries. Now let's see how you can use the PE ratio in real life. This ratio is a powerful tool that can help you make informed investment decisions. Let's say you're interested in investing in the shipping industry and you're considering two companies, FedEx and UPS. Both are giants in the logistics sector, but how do you decide which one to invest in? You look up their PE ratios and see that FedEx has a PE of 15, while UPS has a PE of 20. At first glance, it might seem like FedEx is the better value. Does this mean that FedEx is a better value than UPS? Not necessarily. The PE ratio is just one piece of the puzzle. Not so fast. You also need to consider other factors, such as their growth rates, profitability, and financial health. For instance, if UPS is growing faster or has higher profitability, it might justify a higher PE ratio. However, the PE ratio can give you a starting point for comparing these two companies. It helps you to quickly gauge how the market values each company relative to its earnings. You can also use the PE ratio to compare a company's valuation to its industry average or the overall market. This broader perspective can provide additional insights. For example, if the average PE ratio for the S&P 500 is 20, and a company you're interested in has a PE of 30, it might indicate that the company is overvalued relative to the market. Conversely, a lower PE might suggest it is undervalued. Section 6. Beyond the PE ratio. Exploring other valuation tools. While the PE ratio is a helpful tool, it's important to remember that it's just one piece of the puzzle. It shouldn't be the only factor you consider when evaluating a stock. There are many other valuation ratios and metrics that you can use, such as the price-to-book ratio, the price-to-sales ratio, and the enterprise value-to-EBITDA ratio. Each ratio has its strengths and weaknesses and can provide different insights into a company's valuation. It's like trying to bake a cake. You need more than just flour to make it delicious. You need to use a combination of ingredients to create a well-balanced and flavorful cake. Similarly, you need to use a combination of valuation tools to get a complete picture of a company's worth.